Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. On this podcast, I'm sharing highlights of one of 2023's most valuable events. It was titled, What More Can Quant Bring to Macro Analysis? The content for this event was very thought-provoking as the speakers took a deep look at quant, but never lost sight of the practical challenges to the subsector, particularly the problems that come from models that are based on the last 20 years of very low interest rates, relatively benign inflation, and relatively high government support, and other factors that are currently changing. First, I think Alex Chima Fox, CFA, does a good job clarifying what it takes for quant to work. Alex co-leads ESG research at State Street Associates. Prior to joining SSA, he worked at the RIS Consulting Group, where he built and applied quantitative risk models for customized structured products. Alex holds a bachelor's degree in mathematics and a master's degree in quantitative finance and a master's degree in computer science.
What do you need for quant to work? There needs to be some kind of empirical regularity under a context that you can identify. And that might mean different regimes for when yields are going up because supply is increasing versus other reasons, for example. But as long as you can think through the theory and pin down a reasonable set of conditions where a model makes sense, and where things are going to revert to some average through time. You can do it in fancy ways, you can do it in simple ways. But as long as that can be true, there is a place for quant. And what the quant does is it essentially says, here are some empirical regularities. We're going to encapsulate that in some particular model. And once we have a sense of why that model is why it works and why it will break, then yes, that can be useful. And there's no particular reason that need not apply in the quantitative or in the macro space versus the single stock space. What changes a little in the macro space is in single stocks, you have, say, 10,000 things. So there's a very wide cross-section. So the idiosyncrasies net out a little more for free than if you're looking at G10 currencies, where if you're looking at dollar crosses, cool, now you have 9 cross-sectional units. The idiosyncrasies matter a lot more in those 9 cross-sectional units. But again, to Lauren's point, now we have more measurement. So yeah, if you had a bad measurement of 9 cross-sectional units, it's harder to find an empirical regularity that you're going to be able to confidently trade on. But the more you can understand about those currencies and what's driving their price action, which now we have many more sources, which I'm sure we'll talk a bit about more, that those increased density of the measurement actually itself allows for greater precision on understanding what's going on with the kroner today, what's going on with the Kiwi, or as we broaden the cross-section, it gets easier. If we do EM and DM, well, now we have, say, 30-odd cross-sectional units of currencies. And if we do countries, you might have 45.
The event also showed us what quant can't do. Lauren Johnson, PhD, of PGIM Quantitative, lays out the challenges in modeling. Lauren is a managing director and portfolio manager working with the multi-asset team at PGIM. Prior to joining PGIM, Lauren was a senior portfolio manager at State Street Global Advisors Investment Solutions Group, and his focus was on managing tactical asset allocation portfolios. Previously, Lauren was a portfolio manager at CalPERS and Numeric Investors, and a senior portfolio manager at ABP Investments, and an economist at Caxton Associates. He earned his BA in both public administration and history at California State University, and a master's in applied economics at San Jose University, and a master's and PhD in economics at University of Washington.
Business cycle and the macro environment we're in have, I would say, over the last, we'll say 3 years since COVID, really been turned on their head. So first, what is a business cycle? Did the business cycle that was transpiring into the beginning of 2020 really ended with COVID, because we had a recession which was essentially a few months long and then a massive boom after it. And that's what we're still kind of on the tail end on. So what kind of a business cycle is that? And then what emerged out of that, I think for those of us, as we talked about our journey in our careers over the last 20 plus years or so, was an environment of falling interest rates, low rate volatility, low and falling inflation, and that's all changed dramatically. So for whether you're trying to make a tactical move in the short term or a longer term investment in a multi-asset portfolio, things have changed considerably. And as was mentioned, inflation is a big part of that. and it changes a lot of the dynamics, macro dynamics that we've been, I think, basing our models on, basing our framework and thinking about the macro economy on. And for one, we've seen interest rates come from nothing in a very short period of time to now very elevated levels. And with those higher rate levels is higher rate volatility. And what we've seen just over the summer into the fall now, really volatile rate markets that, in some cases rival the vol that we've seen in equity and the kind of moves that we saw in equity. Nobody had seen a move in bonds like what we saw last year, negative, coincident with a big negative move in equities. And that really went at contrast to what we've been living with for the last 20 plus years, which is an environment with falling rates and bonds playing the role of a diversifying defensive asset in multi-asset portfolios. And that's very up in the air right now, whereas we do see inflation coming down. What we haven't seen is an unwind of this very positive stock bond correlation, although over the last couple of weeks, it's just gone the other way. Whereas towards the end of the third quarter into October, we saw rates moving higher and equities not responding well to that, both moving in a negative direction. That's turned around 180 degrees over the last 2 weeks. We've seen a big rally in bonds and a big rally in equities, not coincidental, I don't think. And, that's a very different place to play if you invest for the long term or the short term. And for shorter term models, of which we do have a large suite of tactical models, some of those are also based on economic relationships that have been tested, say, over the last 25, 30 years. And the underlying components there have changed as well.
That said, Alex pointed out there are some interesting types of alternative data that can work in this environment.
We've certainly seen much wider uptake of the sentiment data. I mean, the flow indicators that I've worked on have been around for a while, though I think awareness of them has grown and usage of them has grown, and that's its own kind of alternative data. So that's certainly grown over time. But I do think that in terms of sentiment indicators, we produce a number of those as well. Those have grown in demand. Certainly, and both not just for single names, which is where they were sort of born, company news and that sort of thing, but more and more in the macro space. So country equity indices directly, which is not quite the same thing that you would get by bubbling up individual companies necessarily. Also at the sector level and certainly at the currency level. But what's interesting is beyond this, I think a few years ago, I know Bob Shiller wrote a book called, the Nobel guy, Bob Shiller, wrote a book called Narrative Economics. And we've actually started to measure narratives. So try to identify narratives that exist and then measure the degree to which investors are following them and the degree to which those exert price impact or don't. Because merely because something gets attention need not mean that it's actually traded upon in any interesting way. And that's sort of a new dimension. So you have the classic cross-sectional units of, say, different currencies in different countries, but more and more people are also looking at these sort of concepts as well as a kind of thing to measure, and then one can measure exposures to those concepts. So which country tends to suffer when a particular geopolitical risk is highlighted? Different countries will have different sensitivities to the latest kerfuffle in the world, and the latest tragedy in the world. So that is a whole new way in which people are looking at this. But of course, we're always trying to improve the measurement. So on the supply side, in essence, we're trying to improve the degree to which that we measure these sorts of sentiments. So one decomposition is into analyzing a given text, one, looking at different sets of agents and combining their sentiment together. So corporate communications, generally useless. Media, often more useful, but you have to pay attention to the source. The Wall Street Journal is a Debbie Downer compared to some other publications, which are a lot more positive in tone. So adjusting for that, putting it into context more and more properly, but simple things like articles that are essentially reporting just the facts. we call this hard content, are often less informative because those articles, that the information in them is already picked up in other feeds that you've been getting for 20 years. Whereas articles that are more soft content, while they're harder to interpret, they can convey more information.
From there, the panelists described what kinds of models they use in their quant analysis, and we had a few good questions from member attendees like you. I hope these clips will make you interested in hearing more from these speakers. You can watch the video on our website at cfany.org. If you would like to learn more about quant, please consider attending the 7th Annual Data Science and Finance Conference we will host with SQA on January 11th, 2024. Until next time, I'm your host, Rob Rowan.